Joining me right now to get ahead of it is Mainstay Capital Management CEO and Chief Investment Strategist, David Kudla. David, great to see you. Thank you so much for being here. What are your expectations for Jay Powell this morning?
I think that he'll actually come out a little bit more hawkish than he did in his last testimony. He talked about 3 rate cuts in 2024. I'm old enough to remember when we were at 6 or 7 rate cuts for 2024, which is just a few months ago. But now we're looking at, rate cuts were originally going to start in March. They've moved out to June. It's likely there could be a one and done. It's likely that there could be no rate cuts because of inflation. This last 1% to get to target is going to be very, very tough. And there's still the risk that inflation could reaccelerate. So we may not see rate cuts for some time yet. And I think he'll allude to that they are going to be very cautious in even that first cut in rates.
So was that the issue for markets yesterday? I mean, it was a broad-based sell-off yesterday. Dow Industrials down better than 400 points. The NASDAQ down 267. Dragged down by 3 tech stocks, which were getting hammered. Shares of Apple down after a report revealed Apple's iPhone sales in China plunged 24% in the first 6 weeks of the year. Tesla was down yesterday, also in China. Weak China sales there and the shutdown of its Berlin factory due to a suspected arson attack. And then shares of AMD were down after reports the Commerce Department did not clear a chip sale in China. All 3 stocks rebounding this morning, but that was sort of the tipping point that sent markets into that tailspin. What else happened yesterday to create that sell-off, do you think?
I think those 3 tech stocks, those mega cap tech stocks that had the sell-off on China concerns, that's what tipped it over. But, we've had a market that's climbed 24% in the last 4 months, the NASDAQ up 27%. We're going to see days like this. It doesn't really mean anything to us. We see futures back up today. We haven't seen as much as a 3% pullback in stocks over the last 4 months. So we think certainly whether it's an event like this or probably it's going to be, as you said, market movers with ADP, JOLTS, and non-farm payrolls on Friday and CPI next Tuesday. Those are the data points we're going to be watching. Those are the market movers that could give us that 4 to 7% sell-off. And if we think about it with how far we've come, that wouldn't be that significant.
Yeah.
We think, though, for the rest of 24, we're still constructive on stocks.
All right, Adam Johnson.
Oh, I love someone who's constructive on stocks. I also appreciate your sense of balance, David. But I think the market's a little unbalanced, and I want to get your take. There are 4 measures of inflation, and CPI is the only one of them that is still above 3%. Why are we so fixated on CPI, and do you think it's out of balance?
Well, we're fixated on CPI. That's the number we all know, the consumer price index. There's a lot of arguments out there about, what real inflation is. And real inflation is higher than what CPI reads. The formula has been changed over time. The housing index was changed back in 1983. They've continued to change that index, and there's an argument that it really doesn't reflect represent the real inflation we're seeing. The Fed looks at PCE. That's their preferred gauge of inflation, which we had core come in around 2.8%. We're going to see some unevenness in those numbers. I think it's just going to be a struggle for them to get all the way to their target in any short period of time.
Are there other stocks or companies that you believe will have a China problem?
I'm sorry, Maria, again?
Are there other companies that you want to talk about that could have a China problem to the tune of the China problems that we're talking about with regard to Apple or AMD, et cetera? I mean, look, China is part of our daily conversation when it comes to national security, but I'm wondering if there are issues about supply or demand given its problems in its economy for other companies here.
Yeah, there's a good story and bad story there. Because of the pandemic, we found out how much the global supply chain was dependent on China. And so companies have been moving to Vietnam, other countries, so that China is not such a linchpin in that global supply chain. That's hurting China. And as we look forward to what President Trump is saying about sanctions, he's going to increase sanctions on China. So that's another nail they have in really a country right now that's uninvestable. So you know, we've been avoiding China altogether.
I thought it was really interesting what Goldman Sachs said just yesterday. Which I was focused on yesterday, and the chief strategist at Goldman Sachs Wealth Management, don't invest in China. Okay, that's from Goldman Sachs. Quite a change in what we're hearing from some of these global managers who were all in on China just a couple years ago. David, thank you. David Kudla joining us this morning on that. We have breaking news right now.